country. They're announcing a $1.4 trillion in stimulus over 5 years.
Record debt. China is teetering on the brink of a financial crisis. An economy that has fueled global growth for years now faces its greatest enemy. Household debt, indebted companies, and the government itself are all driving China into a vortex of unsustainable debt. The question is whether the Asian giant can pull itself out of it, or whether the markets are in danger of a major downturn that could affect the whole world. Hi investors, this is Milan from 𝗕𝗂𝗶𝟐. None of the information in this video is investment recommendation. Always do your own detailed analysis. China has approved a $1.4 trillion plan to shore up its flagging economy by allowing local governments to refinance their debt, unveiling more stimulus measures to counter potentially volatile growth marked by Donald Trump's imminent return to the White House. The finance minister said at a news conference on Friday that loans capped at 6 trillion yuan, $838 billion, would be released over 3 years to help regional governments replace their so-called hidden debt. This kind of debt is usually the risky financing platforms of local governments, backed by the cities or provinces themselves. Minister Lan added that local governments will have access to a separate quota of 4 trillion yuan, $558 billion, in special bonds with a maturity of 5 years, also to reduce their debt burden. The announcement was made at the end of a 5-day meeting of China's top legislative body, the Standing Committee of the National People's Congress, NPC. Since the beginning of this year, affected by a number of factors, the fiscal revenue of central and local governments has fallen short of expectations, Lan said. Refinancing local government debt reduces interest costs, which frees up funds for other spending, said Mark Williams, chief Asia economist at Capital Economics. But the package represents only about 0.5% of current gross domestic product spread over the 5 years of the plan. Clearly, it will not make any appreciable difference, Williams wrote in a research note Friday. Today's fiscal announcement is another disappointment for those who expected a significant stimulus. Years of severe pandemic austerity and a property crisis have drained local government coffers in China, and authorities across the country are struggling with huge debts. The shortage of cash means governments have little means to kickstart economic growth. The problem has reached such an extreme in some places that cities are now unable to provide basic services, and the risk of debt default is increasing. Lan revealed that at the end of 2023, China had a huge hidden debt of 14.3 trillion yuan, $1999 trillion. Officials aim to reduce this to 2.3 trillion yuan, $320 billion by 2028. The scale of the debt swap, which some consider insufficient, has exceeded the expectations of Larry Hu, chief China economist at Macquarie Bank. For those who expected a large fiscal package to be approved at the NPC meeting, it may be a disappointment. However, this expectation is unrealistic, as the policy goal is to achieve the GDP growth target and reduce risks, not to somehow significantly revive the economy, he said. Recently, we have seen other stimulus for the Chinese economy that sent stocks there up tens of percent in a matter of days. Stocks shot up in that time, but are now falling again. Many investors quickly jumped on the bandwagon and are now forced to sell at a loss. Thanks to the fair prices on 𝗕𝗂𝗶𝟐, you will always know if a stock is above or below its fair price, and your decisions will be a little better for it. Economic reflation refers to measures aimed at stimulating growth and fighting deflation, which has become a problem in China. These efforts would require a much more aggressive policy that would go far beyond debt swaps. In the 3-month period from July to September, China's GDP grew by only 4.6% compared to the previous year. That was only slightly more than expected by economists polled by Reuters, who predicted an expansion of 4.5%. Still, at this rate of growth, there is a risk that Beijing will fall short of its annual growth target of around 5%. After a summer full of negative economic news, Chinese leader Xi Jinping finally decided in the last week of September to proceed with a much-needed stimulus package, mainly focused on monetary measures. Since then, economists expect further stimulus measures worth up to 10 trillion yuan, $1.4 trillion, to restore bullish sentiment in the world's second-largest economy. A Nomura analyst estimates China has 50 to 60 trillion yuan, $7 to 8.4 trillion of additional hidden debt, and expects Beijing could allow local authorities to increase debt issuance by 10 trillion yuan over the next few years. This could save local governments 300 billion yuan a year in interest payments. In recent years, the slump in the country's property market has drastically reduced a major source of revenue for local governments. Regional governments also had to spend money on COVID-19 inspections during the pandemic. Even before that, the debt of local Chinese governments had risen to 22% of GDP by the end of 2019, far more than the growth in revenue available to pay that debt, according to an International Monetary Fund report. China is trying to develop the latest technology mainly on its own territory, which is also determined by other countries that restrict China and the supply of technology to its territory. Will China be able to cope with this on its own, or will it hand over the reins of the world's second largest economy to, say, India in the next few years? Write your views in the comments. Good luck with your investments.